Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our fourth quarter market review and outlook report. To say that 2022 was a challenging year for stock and bond investments would be a major understatement. On an absolute basis, 2022 is going to go down as the biggest year of wealth destruction ever for the U.S. equity market. In addition, bond performance in 2022 was the worst on record. Furthermore, last year marks only the third time in over 90 years that both the stock and bond markets have fallen in the same year. As we stated in our previous reports, many inflation indicators such as the Consumer Price Index, commodity prices, and the 5-year inflation break-even rate have likely peaked and are headed lower, giving the Federal Reserve fewer reasons to aggressively raise short-term interest rates from this point. Additionally, all last year we were of the opinion that the economy was not in recession, as unemployment remained historically low and consumers' balance sheets were in good shape. Furthermore, TSA airline travel data indicated an ongoing willingness of U.S. citizens to spend freely on trips and vacations. However, there is an increasing evidence that the global economy is headed for recession due to the efforts by central bankers across the globe to control inflationary pressures by raising interest rates to stymie economic growth. These efforts are aimed at reducing employment and therefore demand for goods and services. As demand declines, pressure on prices will lessen and inflation will likely decline. An unfortunate consequence of these actions is the uncertain impact on corporate earnings and therefore the stock market. While earnings estimates have steadily declined this year, the projections for next year remain in positive territory for large cap and international stocks. Should the analyst projections for 2023 be lowered due to more evidence of downward economic pressure, the stock market may have further to fall in the first half of this year. The primary competition for stocks is the bond market, and with short-term treasuries yielding above 4% and corporate earnings estimates in doubt, many investors are now moving their investment dollars to bonds to reduce portfolio risk. This phenomenon has not been experienced in many years as interest rates are back to 2007 levels. Despite near-term valuation headwinds for stocks, we believe that over the next year, we will see stocks outperform bonds as inflation continues to subside, the Federal Reserve stops raising interest rates, and the stock market anticipates an economic recovery in 2024. International stocks, which have been hurt by the strong U.S. dollar, may see a recovery this year as U.S. interest rates peak and investors take advantage of more attractive valuations found overseas and a weaker dollar. One caveat to our 2023 forecast is the uncertainty surrounding the Federal Reserve and its goal for core inflation to reach 2%. We believe this goal will likely not be achieved for several years, and if the Fed remains determined to drive inflation down to their target over the next year by raising interest rates higher than current projections, stocks will likely suffer. We will be closely following interest rate trends in 2023 as they will heavily influence the severity of any economic downturn and the impact on employment. In sum, while markets will continue to be challenged by economic uncertainty, we feel that inflation will ease this year and the economy will avoid a significant recession. Additionally, over the course of 2023, it's not unreasonable to expect that both stocks and bonds will generate positive returns for investors as inflation subsides. Thank you for watching today, and please read our full market review and outlook report for greater detail on the fourth quarter and our forecast for 2023. Take care, and we'll see you next time.